Dividend growth stocks are among my favorite types of stocks to invest in because they offer both dividend growth as well as share price appreciation, that growth potential, putting the power of compounding into overdrive. I consider a stock to be a dividend growth stock when it shows its ability to consistently increase its dividend year in and year out, and it has a 5-year dividend growth rate of 10% or more. In today's video, we're going to take a look at 3 dividend growth stocks. All 3 of these stocks have a 5-year dividend growth rate of 10% or more. So make sure you stay tuned throughout the entirety of today's video. And before we begin, make sure you smash that like button down below, subscribe to the channel, and let's get started. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is Snowball Analytics. Snowball Analytics is a very powerful tool that you can use to track your portfolio. You can track your dividends to see how much you're getting paid on a monthly basis and an annual basis. And you could also use Snowball Analytics to research future stocks or current stocks that you own as well. It is an all-encompassing one tool that can do all of these great things there. And if you're interested in trying out Snowball Analytics, you can do this completely free for 14 straight days. So definitely check out the link down in the description below. And thank you to Snowball Analytics for sponsoring today's video. All right, let's get back to today's video, taking a look at 3 dividend growth stocks, all of them having 5-year dividend growth rates of 10% or more. Let's begin with dividend growth stock number 1, which is Oracle Corporation, stock ticker ORCL. Artificial intelligence has been all the hype here in 2023, leading to huge gains from the likes of Nvidia and Microsoft, and you can even throw Oracle in that list as well. Oracle currently has a market cap of $318 billion, and in 2023 alone, shares of ORCL have increased by nearly 40%. The intrigue with Oracle is the fact that their software products and offerings, especially their cloud offerings, offer solid margins, and AI is just going to increase those margins for a number of years down the road. The company's cloud services segment, which is by far the largest segment, generated revenues of $4.6 billion in Q1, which grew nearly 30% year over year. Oracle generated operating profit margins of 27.6% during the quarter. In terms of free cash flow, Oracle generated free cash flow of $5.66 billion during the quarter, which grew 21% year over year. This equates to a free cash flow per share of $2 for the quarter and a free cash flow yield of 45%, which is fantastic. Last year, Oracle generated free cash flow per share of $3.06 throughout the entirety of the 12 months. Oracle pays an annual dividend of $1.60 per share, which equates to a dividend yield of 1.4%. And that gives it a free cash flow payout ratio of 52%, which means the dividend is plenty safe and has room to continue growing in the near term. Speaking of growth, Oracle has a 5-year dividend growth rate of nearly 15%, and they have increased their dividend for nearly a decade straight. In terms of valuation, analysts are looking for 2024 EPS of $5.56 per share, which equates to a price-to-earnings multiple of 20.9 times. Over the past 3 years, shares have traded around 17.5 times, which actually seems a little cheap given the expected AI growth moving forward. Speaking of that growth, if you look out here on this fast graphs chart, you can see the EPS growth expectations moving forward. In FY 2023, EPS growth was 4%. In 2024, EPS growth is expected to be 9%. In 2025, 12%, and in FY 2026, 14%, climbing higher each and every year. Dividend growth stock number 2 is UnitedHealth Group, stock ticker UNH. UnitedHealth Group is a managed healthcare provider, working with both individuals and companies of all different sizes. UnitedHealth Group has a market cap of $503 billion, and on the year, shares are up only 5%, as the healthcare sector has been one of the worst performing sectors in the S&P 500 this year. However, over the past 2 months, the stock has caught some momentum, as shares of UNH have increased by nearly 15%. If you're a believer that in the near term the U.S. will dip into a recession, then UnitedHealth Group could be worthy of a second look, because oftentimes, if we are going into recession, you'll see investors move their portfolio into more defensive sectors, and one of those defensive sectors typically is healthcare. During the company's most recent quarter, UNH saw revenues grow 14% year over year to $92.4 billion, with cash flows generated by the company coming in at $6.9 billion. Through the first 9 months of the company's fiscal year, UNH has generated free cash flow of $31.8 billion, which equates to a free cash flow yield of 11.5%. In terms of the dividend, UNH pays an annual dividend of $7.52 per share, which equates to a dividend yield of 1.4%, making that 2 stocks in a row with the same exact dividend yield. However, the dividend growth is a little faster with UNH, as they have a 5-year dividend growth rate of 16%, and they have increased their dividend for 13 consecutive years and counting. Turning our attention to valuation, analysts are looking for UNH to generate EPS of $27.88 per share next year, equating to a price-to-earnings multiple of 19.5 times, which is below their 5-year average of 21.4 times. Dividend growth stock number 3 is Prologis Incorporated, stock ticker PLD. Prologis is a real estate investment trust, or a REIT, operating in the industrial and warehouse sector. This is an indirect play to play the growth in e-commerce. Right now, e-commerce sales account for roughly 15% of all retail sales. And this number, e-commerce sales, are expected to penetrate further and further each of the next 3 years, about 1% each year moving forward, which puts even further demand for properties that Prologis rents out. Prologis has a market cap of $105 billion, and in 2023, the REIT sector has been hammered by high interest rates, leaving the stock pretty much flat on the year. For REITs, much of the focus from an investor standpoint is less on earnings per share and more on FFO, or funds from operation. One of the key reasons is due to the fact that there's a lot of depreciation expense that's put into earnings per share. And again, when it comes to real estate, as we know, real estate is not a depreciating asset class. Real estate over time actually appreciates. So we need to add that back in, which is one of the adjustments that funds from operation does. During the most recent quarter, PLD generated FFO of $1.30 per share and revenues of $1.92 billion, which beat estimates on both the top and bottom lines. In addition, PLD management increased the company's full-year guidance slightly, bringing up the low end of the range. And although rates have been high, it has not slowed the growth of this company, as their development starts is expected to be between $3 to $3.5 billion, higher than their prior guidance of $2.5 to $3 billion. And as e-commerce continues to grow, these tenants need much more space than that of traditional brick and mortar tenants. The company's largest tenant happens to be Amazon. When it comes to REITs, they usually have higher yields and lower dividend growth, but PLD is an anomaly, as they have both a nice size yield at 3.1% to go along with strong dividend growth, a 5-year dividend growth rate of 12.5%. In terms of valuation, analysts are looking for PLD to generate 2024 AFFO of $4.52 per share, which equates to a price to AFFO multiple of 24.6 times, well below their 10-year average of 27.5 times. When it comes to dividend growth stocks, it is intriguing to both growth investors as well as income investors, because you get a little bit of both worlds. You get an increasing dividend each and every year, which helps satisfy those income investors, but you also get solid growth potential from a share price appreciation. Down in the comments section below, let me know which of these 3 dividend growth stocks that we looked at today, and all 3 of them have a 5-year dividend growth rate that is above 10% or more. So down in those comments section below, let me know which of the 3 do you like the best at today's valuation moving forward. And if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you next time. Take care.